afternoon, everyone. Good evening, everyone. We're now getting to our last panel, last day of our conference. We have 2 stars to talk about global asset allocation. One of them is very well known. It's Joe Pawlowski. He is a global strategist and chief of allocation at Morgan Stanley for 30 years. We also have a colleague of mine from Barclays. I worked with him for a long time, Barry Knapp. He was a strategist with a U.S. portfolio. He's also working independently today. Both are renowned. They are always at Bloomberg, CNBC. So how's the debate today? First of all, Jay is going to talk about his calls, what he recommends globally, and then Barry is going to talk a bit more about the United States, Fed, inflation, and all the like in the markets right now.
And all of this that's going on. So now we're going to
so let us hand over to our superstars
to really
know about
this show.
Again, and over to you.
Great. Well, thank you, Roberto, and hello, everyone. I'm excited to be here and excited, I guess, with Barry to bat cleanup on the conference. Hopefully, we'll have a good discussion. Roberto asked me to spend maybe 15 minutes or so talking about my second half outlook, and I'm happy to do so. And when I wrote my second half outlook piece now a couple of months ago, I guess I got an early start on it. I titled it "The Pause That Refreshes," and clearly we've been kind of in a range trading mode across assets, notwithstanding new all-time highs in the U.S. And highs in Europe as well. It's effectively we've been trading in a range, and I expect us to break out of that range to the upside in stocks, in commodities, and in rates as we move from a staggered reopening to a synchronized global expansion as we move through the second half of this year and into 2022. And I use the term expansion because it's important to note that as of Q2, the global economy has recovered back to the fourth quarter 2019 highs. So we've completely recovered from COVID on a global growth basis. And so we're now moving into expansion. And I think that point is really the key strategic point as we look into the second half, the shift from staggered reopening to synchronized global expansion. The tactical key to focus on, at least in my opinion, is kind of the race between the spread of the Delta variant and the vaccine production surge, which is ongoing. And of course, the Delta variant has gotten tremendous amounts of attention. The vaccine production surge has gotten very little. And I'll give you just 2 numbers to keep in mind. The first is that there are expected to be 6 billion doses generated in both the US and Europe combined, 6 billion combined, in the second half of this year. 5 billion of those will be available for export to the rest of the world. The second point worth noting is in the major emerging markets, the percentage of shots given is expected to triple between Q2 and Q4 of 2021 of this year. And so while now we're worried about the variant, and that has caused a pause, certainly in the reflation and cyclical value trade, I believe this is an opportunity. And we're going to move out of this focus on the variant and into an understanding of the vaccine production and then vaccination surge, which is going to allow the synchronized global expansion. So now I'd like to kind of use what we call at QPW Advisory our global risk nexus to walk through climate, economics, politics, policy, and finish with markets. And we'll do this very quickly so we can give Barry a chance to talk and hopefully take some questions. I believe climate is absolutely critical to being a successful investor, to understanding climate here and going forward. I replaced health with its COVID focus with climate 2 months ago. And climate to me is the single biggest global macro trend of the 2020s. And I focus on it in the following fashion. I really look at, in the developed markets, transportation, because that's where the bulk of the emissions come from. And then in the emerging markets, power generation. And what unites the two is carbon pricing. And there's been an absolute ton of information about this over the last couple of days as Europe updates its climate plan, as China begins to roll out its emissions trading system, and as the US starts to focus on climate itself. And so to me, this is the area where investors have significant opportunity to add alpha to their portfolios. On the economic front, I am not an inflationista. Roberto and I actually wrote a piece in February saying not to worry about inflation, and the key to successfully investing from February through June was to not focus on inflation. And I think that has actually worked out reasonably well. I would gladly trade a year or two of 3% inflation for a year or two of 3 to 4% global growth. And that may be what we end up happening. I think the risk of embedded inflation of 5% or more is very low given the demographics, given tech, given productivity, and given the fact that peak growth is already behind us. It's behind us in China. It's peaking right now in the United States. And this is a big question. I think investors are very confused about the difference between peak growth and ongoing growth. So clearly, we're not going to continue to grow at 8 or 10%. We're going to decelerate. The question is, decelerate to what? And I'm of the view that we're going to decelerate to a above trend growth rate in the US, at least in 2022, perhaps 2023. I think Europe is very well placed in the next 3 to 4 years, given their joint recovery fund, which is just beginning to disperse. And we've seen with China and the PBOC cutting the reserve rate requirement that it too is on the case, even though its second quarter numbers were actually quite good. And I would point out that quarter over quarter growth in China was 1.3%, was significantly above expectations. So the idea that the reserve rate cut was a signal that China was rolling over aggressively is, I think, been found to be misplaced. And I would just say that I also think it's important for investors to keep in mind the potential for above trend US growth going forward, driven by 3 factors. The first is the pro-cyclical spending of the Biden administration. The second is the potential for a CapEx boom in the United States. CapEx as a percentage of GDP is at 30-year lows in the US. And the third is a productivity surge driven by the increased penetration and adoption of technology. I think this is something investors should keep close in mind. Switching to politics, with the focus on the US, we have the Biden administration continuing to push its dual track infrastructure approach. I think this is the only way the infrastructure package is going to pass, and so it makes sense. I would also note that in President Biden's speech about voting rights the other day, he asked the Republicans if they have no shame in terms of what they're trying to do on the legislative front. I think that signals kind of the end of bipartisanship. So if we're able to get phase 1 of the infrastructure plan through on a bipartisan basis, pass the much bigger $3.5 trillion family plan on a straight party reconciliation basis, I think that will set up the US quite well relative to concerns about slower growth down the road. I don't expect any significant changes out of elections coming up in Europe or in Japan or elsewhere. I think really the focus is going to be on digging out from COVID. Policy-wise, I think it's important to note that the Fed is in no rush. I think we got reaffirmation of that just today with Chair Powell's speech. Bond vigilantes on the beach allow the Fed to take its time to taper. China, as we just discussed, is kind of on the case to ensure their global their growth path continues without significant declines with its reserve rate cut. And then the ECB has clearly stated that it too is going to take its time removing accommodation. And as I noted, the onset of the Joint Recovery Fund disbursements in Europe sets up Europe very well on the 2022 to 2025 timeframe. So where does that leave us in terms of markets? I've been talking a lot about pothole markets and the need to be able to ride through short-term volatility. And I wrote about that in my recent musings. I think this market has been impressive in how it's been able to burst various bubbles, whether it's the FANG stocks last fall, or the GameStop, or the crypto, or the treasury market. And the market has done a great job bursting bubbles, which allows us, I think, to continue to move forward, albeit being able to ride through some of those potholes. The US has been a twin engine market with both growth and value, something I've talked about, but frankly, I think I've underappreciated a little bit in terms of how it's been able to perform relative to other markets, given that it's the only market really that has both growth and value components to it. If we are able to move forward into synchronized global expansion, I do expect us to come back to the opportunity set that we started the year with, namely non-US equity, cyclical value, et cetera. And I continue to look at opportunities. Some of those segments are now oversold. Look at jets, for example, in the transportation sector in the US, now officially oversold. Treasuries overbought after having rallied almost 8 or 9 days in a row. I do think technicals are important in a market where historically in terms of fundamentals makes it very difficult for investors to understand where they are. Technicals give you a solid grounding as to where you are, where you might go. We have a 3-step approach here at TPW Advisory that I wrote about last week to deal with this environment. The first is keep calm and carry on. Roberto may remember that. We used that in our February piece. Secondly, recognize what's happening in terms of the fundamental and technical position. And then third, take advantage of the opportunities that the market is providing, because it is providing opportunities. We offer 2 model portfolios at TPW Advisory, a global multi-asset model and a global thematic. We call the latter our TPW 20 ETFs representing the thematic universe around the world. And I'm very focused on thematics as an area of opportunity for global macro investing. I think that's where the alpha can be generated, not so much in country versus country or sector versus sector, but in the thematic space that cuts across sectors and cuts across countries. And I'm focused on 3 in particular. The first, climate, no surprise, right? Climate represents 25% of our global thematic model portfolio. Second, cyber. Cyber is clearly a global issue. And by the way, climate has 2 things I want to mention quickly that are, I think, almost quite unique. The first is its global nature. Every single country around the world is focused on reducing its emissions. And secondly, its time frame. We have 10 years till 2030 to reach net carbon. So I think this is a real opportunity set for investors to focus on. And the third, climate, cyber, and then the melding of fintech, crypto, and traditional banking. This is a very, very exciting space that I think is going to offer a lot of opportunity. So as we move to a synchronized global expansion, I expect the laggards to become leaders. That means Japan in the developed equity markets. That means Latin America in the emerging markets, though Latin America has had a bit of a run. It's now pulled back. I think it's another area of opportunity. And we just recently added to health stocks in China with the pullback in the Chinese market. So we remain overweight equities, significantly overweight equities in a global multi-asset portfolio, overweight non-US equities, overweight cyclical and value sectors. We are overweight commodities. I'm a big believer that the focus on ESG, financing, not allowing banks to finance fossil fuel expansion or exploration, coupled with the drive for clean energy and the requirement of minerals and mining there, is setting up for a commodity super cycle. So I'm a believer in the super cycle theory in commodities, and we have a very large overweight in the commodity space. Therefore, we're significantly underweight fixed income across the board, as one might expect. And within currencies, I continue to think the dollar is going to weaken. It has not really to date, but I particularly like the emerging market FX, not really against the majors, but against EM. I think EM is going to outperform on the FX front. And I would note that several major EM countries, Brazil, Mexico, Chile, and Latin America alone, have started to raise rates, thereby inoculating themselves against a Fed taper tantrum risk. So overall, the pause that refreshes, moving from staggered reopenings to synchronized global expansion, laggards become leaders, commodities offer real opportunity, climate, cyber, and fintech in the thematic space. I'll stop there.
It's fantastic, Jay. Thanks very much. And now turning over to Barry.
So I'm a little slower than Jay on the Outlook notes. I'm actually writing mine today, but I will make that available. That brand for my research is titled "It's Never Different This Time," and I think you'll note as I walk through my comments and my outlook with respect to the economic outlook, the inflation outlook, rates, and what's going on there, this extension of the conundrum that arguably began in 2005 or so, or even 2004, Fed policy and what that implies for asset allocation in the US. I think you'll see how I weave in historical analogs in order to strengthen my points and use them as a guidepost for how to think about what's likely to unfold. So I wouldn't describe myself as an inflationista necessarily relative to what Jay said, but I do think that we are moving from a period, a 3-decade long period of disinflation to a reflationary regime. It could very well ultimately result in an inflationary regime, and in many ways, this is reminiscent of what happened in the 1960s. So I'll start there with my historical analog, but it's an interesting one. John F. Kennedy got elected in 1960 with a mandate for much stronger growth. It was the first time since World War II, at least, where we had expansionary fiscal and monetary policy while losing interest in being the steward of the world's reserve currency, which at the time was, the dollar gold reserve. The UK had effectively dropped out of being one of the pillars of Bretton Woods, and we had this ongoing conflict with policy. So through that period in the 60s, the Kennedy administration and later the Johnson administration had very expansive fiscal policy, the so-called, guns and butter, war on poverty, as well as very expansive monetary policy. Bill Martin, who was the chairman of the Fed at the time, described the Fed as independent within, not of the government. And I think that's a good way to think about the position that the Fed is likely to find themselves in within a couple of years' time. Not so much as it applies to this taper discussion that I'll get to shortly, but how to think about the broader environment. So my inflation argument or reflation argument is really very simple, and it just goes back to looking at the components of CPI, or the Fed's preferred measure, the core PCED, personal consumption expenditure deflator, over the last 3 decades. And what you see is service sector inflation has persistently run above 3%. Yeah, it came down to some extent from the 90s to the O's and even into the 10s, but it's been above the Fed's target all along. That's generally domestically determined, and it's run well above the Fed's target. Energy prices, we've had positive or price shocks like we had from this shale oil technology last cycle, which was a disinflationary shock. And we've had periods of stronger energy prices. That's come and gone. But goods prices have been running negative for decades. And their maximum point of deflationary impulse was in 2003 and 2004, shortly after China was admitted to the WTO. And it's very clear why this happened. Charles Goodhart and Manoj Pradhan have written about this. They wrote initially papers, which Morgan Stanley published in 15, and then later a BIS paper. And now they have a book out that's next on my reading list, actually, describing how the global supply of industrialized labor went from 750 million workers, in 1990 to 2 billion by 2010. You don't need a PhD in economics, which, by the way, I don't have, to know what happens to wage costs and resulting global goods prices as a consequence of that big an increase in the supply of labor. But those forces are all in reverse. The Boston Consulting Group wrote a report back in 2012 that the economics had largely been corrected by economic forces. Productivity adjusted labor costs have converged from the China to the rest of the developed world. Transportation costs have risen. Relative energy costs have fallen here in the US to the rest of the world. And notably, exchange rate risks and supply chain risks have gone up dramatically. The supply chain risks began in 2011 with the Great East Japan earthquake and tsunami that shut down the auto industry for 3 or 4 months. Then you had the floods in Thailand the same year that impaired electronics and semiconductors. The Trump trade war was the major supply shock. And of course, the pandemic was the mother of all supply shocks that we're still dealing with. This is the catalyst to restructure global supply chains. And what you saw in the 2000s was Asian exports, China, Japan, South Korea, Taiwan, grew at 15% annualized rate. That slowed to 5% in the 2010s. It's likely to slow further. So that disinflationary impulse from goods prices is unlikely to persist through the 2020s. Now, I absolutely agree with Jay that we're looking at a positive productivity shock. That began actually in 2018. Part of it was related to tax policy, which was beneficial. But part of it was technology innovation adoption, as Jay indicated. I've written quite a bit about that over time. One of the single best examples, I think, is if you look at Starbucks. Starbucks comparable store sales had completely stalled out in the middle 2010s. They invested quite a bit of money in their technology, their app infrastructure. A third of their customers now come in and pre-buy the coffee and just pick the coffee up and go. That solved their assembly line barista problem, and their comps started increasing at a 5% annualized rate. It's a perfect example. Anyone who's ever been through Newark Airport would realize in Terminal C, the United Terminal, you can't pay a human being for a cup of coffee or a protein bar. It's all being done through technology innovation. That technology innovation is going to get dispersed or diffused through the healthcare sector, the industrial sector, increasingly in the financial sector, and of course, it's already going on in consumer sectors. So that is a offset to this inflationary impulse that will result in reflation like the 60s, as opposed to going straight to the 70s, as the more hyperbolic TV pundits would lead you to believe. And so that's an important dynamic when you think about asset allocation, if I'm correct about that progression in the US, because the price to earnings ratio of the S&P 500 had risen from the end of World War II from 7 to 20 by the time JFK was elected. The 50s were a very uneven decade in terms of growth. We had 5 recessions from the end of World War II through 1960. We had very weak capital formation, capital investment in the 50s. We had massive Fed intervention in the bond market in the beginning of that period. But by the 1960s, growth accelerated because nominal GDP went up and operating leverage increased. This is not the prices paid versus prices received marginal cost argument. This is higher revenues against your fixed costs, which you don't have to replace right away. And earnings growth accelerated to 15%. and stayed there until around about 1967 when the inflation impulse got out of control. As a consequence, equity returns were pretty good. So for me, that's a decent analog. By the way, bond returns were terrible through that time period. So that's broadly how I would think about the inflation outlook. I'm a reflationist or a reflationista, if that's a thing. But in the beginning stages of that, it's going to be fine. Obviously, this is going to be a political issue. Anyone who listened to the testimony the last couple of days realize that. But when nominal wage growth is accelerating, that's what the household sector sees. So that will dominate the psychology of the public and the market and market participants for some time to come. So moving on to the rates environment and this conundrum dynamic that kind of has everyone scratching their heads. When we had that impulsive move in the first quarter, forecasts for rates fully normalizing in a very short period of time obviously proliferated. But I think it's worth, again, going back in time and thinking about what's been going on in the U.S. rates market going all the way back to the middle 2000s. The 10-year Treasury yield was higher than nominal GDP from the end of World War II through about 2005. It then fell below that, and it was largely a consequence of this same globalization dynamic, right? Bernanke called it the global savings glut. So in the 2000s, we used to use the real interest yield as a pretty good proxy for the growth outlook. That signal weakened as we got through 2004 or 5 into 2006 when the Japanese started unwinding their QE program. It unwound a little bit and you saw rates finally go up and the curve steepen a bit. But that signal, that idea that treasuries were giving you a proxy for the growth outlook had really weakened significantly during the conundrum period. In the 2010s, it was gone. It was all about Fed policy. We still had those same forces, but Fed policy really determined the direction of real rates. In 2021, we had another significant change. And what I'm going to argue here is the impulsive move in rates in the first quarter. This, I think, is consistent with something Jay was saying as well, which was not to get too focused on the inflation outlook. It was almost entirely a function of the shocking January 5th Senate elections in Georgia, the blue wave, and then the unexpected additional $1.9 trillion in fiscal spending that the bond market had to reprice. Now, this is the first time in my career, going back to the early 80s, where you could truly see the bond market reprice to absorb Treasury supply in a meaningful way. And the way I would illustrate this, and anyone can go out and have a look at it, is the 30-year TIPS yield or real rate was only about 10 basis points above its August 2020 low in early January. 10-year yields had moved up, the rest of the curve had moved, but that 30-year real rate, which was outside of the Fed's scope of operations, their average duration of Fed purchases now is 6 years. This is decidedly different than the taper tantrum in 2013 when the average duration was 12 years. So they weren't buying bonds out in the long end. You saw that 30-year real rate jump 60 basis points in about 6 weeks through the signing of the American Recovery Plan. After that was done and the spending agenda started to stall out and we started talking about bipartisan infrastructure plans, and that you saw that entire move retraced. And part of the reason that it was retraced is because that money found its way back into the Treasury market. And the way it went, the mechanism for that was the Treasury had $1.7 trillion on deposit in the Fed, at the Fed. That's called the TJA account, Treasury General Account. They sent checks to individuals. Those went into bank deposits, and they stopped their Treasury bill issuance. So that caused bank reserves to surge. Banks, of course, didn't have loan demand at that point. They are now seeing a pickup in consumer loan demand, but commercial and industrial lending will not pick up until bottlenecks clear and they start making inventory investment, which will happen in the second half and into next year. So they had no recourse other than to deposit it at the Fed at a zero interest rate under the RRP program. They now get 5 basis points since the last Fed meeting, or to buy some treasuries. So that recycling process, that draining of the Treasury general account, it was $1 trillion from late February through today. That is about to end, by the way. That was a major contributor to the rally in the Treasury market. Additionally, we've had this surge in the U.S. trade deficit or decline. We're at the largest size we've ever been at the trade deficit. As you all know, the Chinese made a decision in late May to no longer allow their currency to appreciate. That, of course, created more demand for U.S. treasuries. Japan and Europe run current account surpluses, so their trade surpluses are getting recycled into treasuries. And of course, the Fed continues to buy 120 billion per month. So that liquidity dynamic explains it. Keep in mind, we've had major lows in the treasury market 5 consecutive summers. This, we think, will be number 6. It was Brexit, then it was the Trump agenda stalling out. It was followed by, in 2018, it was the quantitative tightening process. In 2019, it was the trade war. And in 2020, it was the pandemic. And then major moves higher in rates in the second half of the year. And we are set up for the same dynamic because that treasury process is almost done, because the recovery in global trade is probably close to a peak, and because the Fed is likely to start easing back on asset purchases in the near term. It's a close call, but it's highly possible that they make that decision at the next FOMC meeting, which is less than 2 weeks away. It was 2 weeks from when Jay Powell was testifying on the Hill. Now, just to give you a little inside baseball on all that, you've got a couple of decided camps on this. You have the head of the Dallas Fed and head of the St. Louis Fed arguing that they should go right away, partially because of the mortgage market. And you've got the San Francisco former Fed president of the San Francisco Fed, who's now the New York Fed president, and current San Francisco Fed president arguing they shouldn't. The leadership has been completely non-committal. Jay Powell was never going to announce a policy change to Congress. That would be an absolute disaster and would guarantee that he does not get reappointed. He probably won't anyway, but he would never do that. Since the last FOMC meeting, we have not had a Rich Clarida speech. He's number 2 and head of monetary policy. And we've not had a Lael Brainerd speech, who is the leading candidate to become the next Jerome Powell. So the leadership's been silent on this, and there's going to be a very heated discussion, and the housing market is at the core of it because we have house price appreciation faster than we had in 2005 and 2006. And we have the correlation of the 20 cities in the old Case-Shiller home price index even more highly correlated than they were in 2005 and 2006, implying that macro factors are driving up house prices. You just don't need this level of accommodation in housing right now, and the Fed knows that. Which brings me to the implications of when the Fed does tighten and why this is not a taper tantrum, okay? Since World War II, there's been one Fed policy normalization related correction generally per cycle. There was one in 94 during the very aggressive tightening cycle, one in 2004 during the measured removal of policy accommodation. Last cycle, there were 8. QE1, QE2, Operation Twist, QE3, the taper tantrum, quantitative tightening, balance sheet runoff, the gamut. They used to average 8%. They now average 11%. And the mechanism for causing bigger risk-off shocks in the 2010s is the mortgage market and what that does to volatility in the U.S. I was in equity derivatives at Lehman Brothers for 20 years. This is right up my alley, but the single biggest source of implied volatility of interest rate risk in the world is prepayment risk on 30-year fixed rate mortgages. Prior to the global financial crisis, if rates went down, volatility went up, implied volatility went up. After the global financial crisis, the Fed drove them both down simultaneously. In those episodes, when they ease back on their mortgage buying, that transfers that risk back to the private sector. It winds up on mortgage desks. Their value at risk goes up. So then they tell the equity derivative team, cut your value at risk. The credit team, cut your value at risk. It permeates out through hedge funds, money managers, through the entire gamut, and we have these significant risk-off shocks. They are not terminal for the business cycle. They're not terminal for the equity market advance. They are your best buying opportunities, other than if you bought on the lows, during the pandemic. This will be your window to add capital to the market, but they are significant. If you are all in right now, we are faced with the probability of a 10 to 12% fairly high volatility impulsive correction as the Fed tapers asset purchases, which has nothing to do with expectations. I got the BlackRock in 2014. They said it's in the market. It's not going to matter. And in October, the stock market was still down 12%. It dropped like a stone because of that transference of that risk. So that risk is significant, and it will lead to a pullback. But again, if you're a long-term investor, this is a great buying opportunity. And it also marks the transition to mid-cycle when I think you really should seriously start focusing on thematic trades. That was one of my jobs at BlackRock, was to work on long-term thematic ideas. And I would throw a couple of them out there at you. One is totally consistent with what Jay said. I expect a very strong capital investment cycle in the U.S. That'll be very good news for the industrial sector, for example. But more broadly, the benefits of digitization, movement to the cloud, are going to accrue to the consumers of that technology from the producers of that technology. Much like in the 90s, when the tech sector built up a massive amount of capacity, and then the sector was at best a market performer in the 2000s as that technology got taken up by media and a number of other sectors. We're going to have a muted version of the same this cycle. We had massive cloud investment, digitization in the 2010s. The tech sector was the best performer. In the 2020s, those benefits accrue to healthcare, which has been a drag on productivity in this country for 4 decades. Using technology to better deliver healthcare services. The manufacturing sector, automated production as we restructure global supply chains. The financial sector, for sure. It's not clear the big banks will be leaders there. Might be fintech. And of course, it's already happened in the consumer sector to the point where it's not even a price effect any longer. It's just a convenience yield. So this is another reason why we won't have the level of disinflation that we had, because you don't get stuff any cheaper at Amazon than you get it in the store. You just get it without leaving your house. So anyway, when I think about asset allocation within the U.S. Going forward, as we get through this risk-off shock, I do like the reflationary sectors. I'm overweight. I took materials down to a market weight. It's a smaller sector here in the U.S. I would likely, re-rate that back to an overweight after this risk-off shock occurs. Hopefully I'll be correct about that. I'm overweight energy, financials, industrials, and I went to a market weight on tech last August, tech and communication services, and I expect to stay there through the cycle. That still means you have a big allocation, because in this country, it's a lot of the index, but that's where you should be. I'm underweight treasuries, underweight rates, and I've got a bit of a high yield position, but I do think the way to offset this risk, if it's something that you need to get yourself in shape for, is to temporarily raise cash. I would not try and shift into more defensive sectors, because I do not believe they will perform well through the cycle. And volatility is pretty attractive right now. Convex volatility trades are pretty attractive. Buying put spreads, for example, because the skew, the premium for out of the money puts is quite rich right now, sets up very well. Bond volatility is incredibly cheap because of what I described earlier. That's another good hedge as well, particularly in that belly of the curve when the Fed stops buying. You should get a pretty good move in both rates and volatility. So you kind of win on both sides if you have bond puts on. And so that's how I would be thinking about the second half of the year. Those corrections generally last about 60 days, so about 2 months, and they reverse more quickly than that, which, if the Fed gets started on this right away, does set us up for the equity market ending higher than it is right now, even notwithstanding that sharp move. If they wait longer, the risk goes up, in part because if they do it in the fourth quarter, we learned in 2018 what happens to failed favorable seasonality during the QT crash in December of 2018. We surely don't want the Fed to start the tightening process then. They either wait till next year, but the longer they wait, the more this volatility issue builds and the bigger the reaction. So best they get started now and stop providing that stimulus to the housing market. There is a pretty serious audience within the Fed, including Christopher Waller, who's now at the Fed Board of Governors. I'm sure Clarida is sympathetic to this, having worked at PIMCO. And I do think they're likely to get started on tapering asset purchases, leading with mortgages sooner rather than later. As I said, it's a close call for the next Fed meeting in less than 2 weeks' time. So I don't know if I went a little over my time. If so, I apologize.
No, but that's fine. That's great. One question I have for both is, and then we'll start with Jay, is I mean, it's more on the macro front, but it's the idea. I mean, a lot of people are saying that we're going to enter a phase of financial repression, and that with the world awash in debt, we need some inflation, to solve the debt problem, and that's exactly what the Fed and other central banks want. But it's kind of a very fine tuning, because you want some inflation, but not too much of it. Otherwise, they would lose control of the bond market. So first, Jay, how where are you stand on that debate? Do you and how does that affect your asset allocation? I guess it's on the underweight, a bond call. But if you can explore a little bit more,
Sure. I think we kind of have entered a bear market in sovereign debt in the developed markets. I expect rates to go higher because I think we're, like Barry said, I think we're probably both reflationistas, and expect the global economy to be pretty robust. Expect at least in my case, a commodity super cycle. And so I would expect rates to be higher over time, and therefore want to be significantly underweight bonds. I think the risk reward is horrible. I mean, as I think Lee Cooperman said, they're a return-free risk asset, which I thought was always a great kind of play on words for the treasury market. And so I do think repression, allowing inflation to run a little bit. Look, I mean, Europe would love some inflation. Japan would love some inflation. The US can easily deal with a little bit of inflation. Most of the studies show that it's not until you get inflation running, CPI inflation running at 5% for a year or more before it really becomes problematic. And I think it's highly, highly unlikely that we're going to get anywhere close to that. But if we get 3% inflation, kind of CPI or core PCE at Barry, I think is much better placed to kind of get into the specifics. I'm also not an economist, but I think that's not going to be a problem. And as I said in my remarks, I'd gladly trade 3% inflation for 3 to 4% real GDP growth, which would obviously then you would put, it's hard to imagine how you could get or can stay with a 10-year treasury at, 1.3, 1.5. I continue to think we'll be closer to 2% by the end of the year on the 10-year. That was my target in November of last year when I wrote my outlook piece for 2021. That continues to be my target, somewhere, 50 basis points, 70 basis points above where we are today. I think that's reasonable to expect.
That's great.
Well, I started writing about financial repression and the similarities to the 1950s in 2011. And I had done quite a bit of study on it. And, if you look at that period post World War II, we had explicit interest rate caps, roughly the equivalent of bond large scale asset purchases or QE. We had a very repressive or strict regulatory regime in the banking system. Return on equity never exceeded 10% for the whole of the 1950s, much like it it didn't through the whole of the 2010s. It wasn't until the Trump administration financial sector regulatory reform that began in 2017, and finally by the end of 2018, return on equity exceeded 10% for the banks. By the way, they've recovered from a drop to 7% during the pandemic to 12% today. So that is 10% is kind of a key level where those stocks start earning more than their cost of capital, trading at a premium to book, and building equity and contributing to credit creation. So that's sort of a big issue. So for me, in many ways, financial repression was at its most acute phase in the 2010s. It's easing, but it nevertheless exists. I mean, there's a huge problem in the banking system right now with, an arcane regulatory requirement called the supplementary leverage ratio, which Jerome Powell described as intended to be a backstop for Basel risk-based capital requirements, which, by the way, Basel risk-based capital requirements are a form of financial repression because you have zero risk weights on treasuries or agency mortgage-backed securities and much higher risk weights on corporate debt and private sector loans. So this is a way to get the banking system to finance the massive government debt. But that supplementary leverage ratio is now binding in this massive reserve requirement, which is a function of the fiscal and monetary policy. They created an exemption during the pandemic. They then, for political reasons, ended the exemption. And you've seen as much as $1 trillion per day in the Fed RRP program because the banks, this is creating a huge problem for them. It's not a problem that is impairing economic growth right now because demand for credit is not yet strong enough. The household sector is in great shape, but it could become binding through the crisis or through the expansion, So financial repression is ever present, but not nearly as acute as it was in the 10s. The way governments traditionally get out of excessive levels of government debt, and by the way, the Biden spending plans will take government spending to 25% of GDP, a level it was last at during World War II. We've never been able to collect much more than 18% of GDP in receipts. So unless we're willing to go to a VAT tax, we're going to increase the debt pretty rapidly in the 2020s. The typical approach is to try and tax their way out of it. As my 18% metrics implies, that never works. So then the next step is to try and inflate their way out of it. And, again, the way Jay and I are describing this is it starts slowly. And then the question is, do we ever have the political will to cut the spending back to a level that's sustainable? Or do we wind up moving from reflation to inflation like we did in the late 60s into the 70s? And that's a story for another day. I would not let that dynamic impair your asset allocation decisions today. It's just not a factor. It won't be a factor for, half the business cycle at the earliest. But it is it's a long-term, thought-provoking discussion.
No, it's excellent. And another thing we've talked about was, and it was Barry's point about, the cheap labor supply shock from 1990 to 2010, the numbers that you mentioned, and we can argue that and it's right that China has stopped exporting deflation, and now there could be a different phenomenon, which is a result of geopolitics and also other things, which is the relocation of supply chains out of China, and of course, to some other emerging markets, but potentially to some developed markets. How do you see this, and how would that affect your calls or allocations?
Well, I'll start since I brought it up. For me, it's a key theme that I started really researching and focusing on back in 2011 and 12, when it became clear that we had this 100-year supply of cheap natural gas, and that a lot of these benefits had been arbitraged away, and then we had these supply chain shocks. And I'll give you an anecdote around this. Boeing continues to struggle with the 787 aircraft. If anyone's ever flown in it, it is a great plane, right? Fly from the U.S. to Brazil overnight. There's more oxygen in the cabin. It's really a great plane. That plane is a poster child for globalization gone wild. Boeing basically put distributed manufacturing in as many countries in the world as they possibly could, so they could sell that plane to their national airlines. And it's a supply chain absolute mess. And here we are. It took 3 years longer than expected to develop it. It was at the height of globalization, and they're still struggling with that plane. So, for me, this was always inevitable. I'm not arguing that, we're going through deglobalization. Sounds so negative, right? It's just the rate of change of globalization has slowed decidedly. And it does take shocks to get businesses to restructure supply chains. But I think we've had a significant enough of those shocks, and the economics really haven't made sense in a lot of cases for quite some time. So I think it's inevitable. And that's part of my thesis on a strong capital spending cycle in the US, is rebuilding our physical capital stock to a point. Again, this isn't going to drive huge amounts of employment, because it will be highly automated. It's the only way the US can compete. But, this is inevitable. I mean, even in steel production, my understanding is that labor costs are about 3% of the cost of goods sold, right? So you're going to see that permeate out through lots of different products, and just taking advantage of cheap labor is a story that is in the past.
I would just add, Roberto, that this is a big part of my whole outlook, our tripolar world framework, which argues that the next phase of globalization is regional deepening or regional integration in the three main regions of Asia, Europe, and the Americas. Barry touched on a lot of the rationales behind that, so I won't repeat those. I would just extend it a little bit and say that I think the geopolitics around technology, for example, is driving this as well as the focus on climate and the need to be able to have the access to certain things like electric vehicle batteries, for example. So you see Europe wanting to produce semiconductors. You see the United States arguing that it should be able to produce semiconductors. You see a real focus on electric vehicle battery production in each region. So to me, this is all part and parcel of what's been unfolding in my view, my worldview, since the great financial crisis in 2008, 2009, which really broke the tip of the globalization spear, which was the financial sector. And we've been basically unwinding ever since. This is another phase, the unwinding of the physical supply chain, which will also be augmented by the digitalization of everything as well. So I think this is an ongoing theme. It's something that at TPW, that's the name, Tripolar World TPW Advisory. It's something we think about every day. It's a big part of how we view the world, and it's a big part of the reason why we think the area of opportunity in the next couple of years, global leadership in the equity markets, is shifting away from the United States to the rest of the world. And I think that's going to be a great opportunity for investors to actually allocate beyond simply U.S. equity and U.S. big cap tech.
Mm-hmm. No, that's fantastic. And another question I have is, if you could both, explore a little bit, is, on the, there was European, announcement, on the climate plan. We already talked about it, and there is a, you need a lot of supply of new materials. So, lithium and these sort of things. So, is your, commodity allocation already reflect on that, and is there room to increase? And also, what's your view on the creation of a global carbon market? China, made some steps towards it, and in Europe now talking about the carbon border adjustment. So, will you treat carbon as a separate commodity?
I do, and it's one of our single biggest positions. In fact, I think it is the biggest single position in our global thematic model portfolio, because I think it's quite clear that the price of carbon is going to have to go up. Depends on who you want to talk to. The OECD says it needs to triple from current levels. Wood Mackenzie, which is a noted energy consulting and forecasting company, says a quadruple between now and 2030. So carbon, there's one certainty in the world, is that the price of carbon is going to go up and go up significantly. And one of the things that's really unique about this is that the markets are priced to go, they're built to go up in price. And in the news over the last day or two of the expansion of the European climate plan and the extension and build out of its ETS, its emissions trading system, reinforces this, where they are going to reduce the number of allowances, which means obviously the allowances that are left go up in price, and B, they're going to speed that process up in the next couple of years to shrink the allowances even further. So what's unique about the carbon market is that it is built to rise in price. So as investors, and that's one of the reasons why it's the biggest single position in the thematic model portfolio, is because I think the risk reward is absolutely compelling, particularly on a long-term point of view. Absolutely compelling. And so for me, climate, as I mentioned earlier, the single biggest segment of the global thematic model portfolio at 25 or 26%. Included in that is carbon. Included in that is lithium. You can buy LIT, the lithium ETF, also doing very well. You can buy electric vehicles, etc. So I think that the global carbon market is starting to really move. And just look at what was written in the last couple of days. Not only did Europe really say we're going to impose a carbon border adjustment mechanism, but the US said, that's not a bad idea. And then the Senate, the Democratic leadership, said that we would like to think about doing that in the United States. Those are words that have not been heard here virtually ever. Carbon tax has been something that's been completely verboten in the US political discussion orbit for decades. Yeah. And so things are moving very rapidly. China is recognizing this and recognize that if the US and Europe agree to have a carbon border adjustment mechanism within US and Europe, so two of the three regions, and leave China out, then China has a major problem in its export production system, right? So China is recognizing that it needs to get its own ETS system going up quickly so that it can force its companies along. Otherwise, strategically, it is very, very at risk. And I'll just give you two numbers to give you an illustration. The price of carbon in China today is $3 to $5 a ton. In the writing about their rollout of the ETS system, they're talking about $6 to $7 a ton in the next 1 to 2 years. In Europe, it's basically $40 to $50 a ton today. So just imagine if Europe and the US is in California, I think it's $20 a ton in the California system. So just imagine if the US and Europe agree to a CBAM, carbon border adjustment mechanism / tax, that would be somewhere in the $30 to $40 range. In China, it's priced at 1/10 of that. They're almost by definition, any of their major carbon emitting exports become uneconomic right off the bat. So strategically, this is a huge deal. And if the US and Europe really wanted to play hardball with China in terms of geopolitics, this is the next area of opportunity. I'm not sure we're going to get there, but I have been, as someone who's been paying a lot of attention to this and is significantly invested in it, I have been really impressed by the tone of conversation around CBAM in both Europe and the US over the last week.
No, that's fantastic. So we are right at the mark. So I'd like both of you to do 2-minute remarks on anything that we may have left or 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 whatever you feel it's appropriate, given the environment we're in. So let's start with Barry and then Jay.
Well, it's been a pretty comprehensive discussion, and I've learned some things about carbon in particular that probably bear some additional research on my part. I think that the outlook for the U.S. is a very favorable one. I didn't see the bond market sell-off as having anything to do with the U.S. growth outlook. It had more to do with the global growth outlook, but more than anything to do with this idea that the Biden spending agenda had stalled, which it hasn't. Jay talked about that, and I absolutely agree. They passed a $3.5 trillion budget resolution, and that is going to have to get priced in the market. So we are headed towards higher rates, and ultimately inflation will be a driver of those higher rates through the cycle, or reflation, as I've described. But the real near-term catalyst has just been trying to absorb all this massive supply. So I would definitely be negative rates and think we've reached a major inflection point in the bond market. But that is not necessarily a bad thing for equities, as I illustrated in the early 60s. Stronger earnings growth, faster nominal GDP, faster revenue growth, created operating leverage, and the environment was still pretty good for equities for some time. Eventually, we're going to have to deal with the massive increase in U.S. government debt in the U.S. We're not Japan. We don't have the same level of savings. It's not a closed system. That analog is not a good one. So there's longer term issues, but in the near term, we have this policy shock coming. That's a buying opportunity for longer term investors. And when that's complete, we'll move into mid-cycle, and some of these more thematic ideas are really going to be prevalent. So be long the reflation trades, and don't give up on tech, but don't lean into it like you should have been doing last cycle.
Yep. Great. Thank you. Jay?
Yeah, I would just pick up on what Barry said, and that if he's correct, and I think he will be on the outlook for higher rates in the U.S., I think that's going to jumpstart not only kind of a move back into the cyclical and value reflation sectors within the U.S., but also drive renewed interest in other markets like Europe and Japan, which are cyclical plays by definition. For example, Japan, which is a market that gets almost no attention equity-wise. Even Europe has done pretty well this year. Japan is virtually flat. If you look at EWJ, for example, virtually flat on the year. But Japan, 22%, the single biggest sector in EWJ is industrials. So I think that the opportunity set to kick off not only higher rates in the US, but then Europe as well. I continue to think that the Bund, the German Bund, which is at minus 30 basis points, will be closer to zero, if not a positive number by the end of this year. I continue to really think European banks are very, very attractive. The US banks are now able to return capital. I expect that same decision to come in Europe in the next couple of months, probably starting the actual physical return of capital in 2022. But I think the cyclical nature of Japan, which is a cheap market, I think it's trading at a 70% discount to the US on a price to book basis. It's an under-owned market, particularly by foreigners. It's had a terrible story on the vaccination front, on the Olympic front. I expect that narrative to change. I do expect the Olympics to go off pretty successfully, albeit without crowds, which is a disappointment. But hey, we did that with the NBA finals. We did that with hockey. It's doable. I expect that to happen. And one little subtle point that's worth thinking about is that with the yen, dollar yen at 110, 111, my understanding that the Japanese corporates have priced or pegged for year-end 2021, which is March of next year, 105, 106 rate. So you have the likelihood of earning surprises as that weaker yen feeds into better earnings. So to me, I would suggest that investors, start to broaden their horizons a little bit. We've been focused for a decade, as Barry noted, on US and US tech. It's time to look elsewhere, develop an understanding of cyclicality in places like Japan, Europe, parts of EM. EM is now almost entirely, EEM, a Asia-looking environment, China, South Korea, Taiwan, places like Latin America, places like Europe. They will be the beneficiaries of this regional integration as production moves more regional. Eastern Europe should be a big winner. Mexico, Central, South America should potentially be a big winner as well. So I think that's my advice, is to spread your wings a little bit and look beyond the places that have been the winners of the last decade. The winners of the 2020s going to be considerably different, in my view, than the winners of the 2010s, and that will include non-US equity and thematics in particular.
That's great. So thanks very much, Barry. Thanks very much, Jay. It was a master class and it was a great